Welcome to this discussion on fractional ownership of real estate for a 1031 exchange. My name is Nick Prassis and I'm a registered investment advisor. Fractional ownership of real estate has been very popular for a simple reason. Investors love real estate, but they don't love the idea of managing the property themselves. So very often these investors will seek out a passive fractional ownership in a real estate partnership. And this has been an alternative for everyone other than the 1031 exchange investor who wishes to sell their own property and then do a tax-deferred exchange into a fractional ownership. And this was not possible, at least not until 2002, when the IRS issued revised guidelines and regulations that did in fact permit a 1031 exchange into a fractional ownership. And at this point, an entirely new industry was created. The first version of a fractional ownership was a tenant in common property, or a TIC. This was the original structure in which investors purchased a direct ownership interest in the underlying property. The attraction was that it met the IRS guidelines for a 1031 exchange, but that also the investors retained control of key decisions while delegating other more mundane management duties to a third-party management company. Many investors were initially reluctant to hand over total control of their investment to a management company. And so the ability to retain control over certain key decisions was a key attraction of this kind of investment. DSTs were very popular up until about 2008 when we entered an economic recession, and then certain fatal flaws became evident in the structure. The first was that the investors were subject to a capital call, in that if the property required some form of capital improvement or for some reason the lease revenue was insufficient to make the debt service payments, investors were required to contribute additional capital to make these payments. But by far, the greatest failing of the TIC structure was ironically the voting rights provision that attracted many to the TIC in the first place. In a tough market, when the investors really had to come together and make tough decisions, very often they couldn't do it. Investor discussions and voting collapsed into disagreements, into stalemates, into disputes, and very often small problems needlessly became big problems. And so the voting rights provision really was the Achilles heel of the TIC structure. The next refined structure, that is the structure that is currently in use today, is the Delaware Statutory Trust, or the DST. And in this case, the investment property, or the portfolio of properties, is held in a trust. The investors purchase shares or interests in the trust, and the property manager retains all decision-making authority, which is really the appropriate structure for a fractional ownership property. And in fact, most investors seem to really enjoy the aspect of a passive check while delegating all the headaches to a third-party manager. And this feature is very popular among DSTs. Because of the nature of the management contract, this investment is actually considered a security and is in fact regulated by the SEC. And as such, the disclosure is much more extensive. A DST investor receives a prospectus much like they would if they were investing in a mutual fund or a real estate investment trust. Also, the investor must meet the accredited investor requirement of either a $1 million net worth or an annual income of $200,000. The advantages of a DST are that these are generally large institutional properties with investment-grade tenants. Often they are very high credit quality, much higher than an individual investor could achieve on their own, with their own property. There's an opportunity for geographic diversification. Most real estate investors tend to buy properties that are close to home so that they're within driving distance so that they can manage them. In a DST, or a portfolio of DSTs, the investor can invest in properties throughout the country that have different growth and income characteristics. In a DST, there are no moving parts. If an investor invests in a mutual fund or a REIT, they are really investing in the manager's ability to skillfully buy and sell properties in a way that increases the value of the fund. In a DST, the property never changes. The investor can evaluate the property, see if it meets their own particular needs, and the property will stay the same throughout the entire holding period until its ultimate sale. In a DST, there are no capital calls. Whatever the initial capital contribution is, that it is fixed, and there are no future requirements for additional funding. So a DST really offers the benefits of a fractional ownership without the previous potential for investor disputes or management responsibility. The advantages of a DST sponsor, which is what we call the professional management company, are that they are, in fact, professionally managed. Often these sponsors have hundreds of millions, if not billions of dollars under management. They are very dispassionate about their management approach. They have clear buy and sell criteria. They have an entire management infrastructure in place. They are often national in scope, so they offer a variety of DST products throughout the country. They have extensive lending relationships, so they can often get the best loans and the best terms, particularly in a tough lending market. They also have extensive leasing relationships since they are always in the market, and they are in the best position to fill an empty building or maximize their leasing terms. And the DST sponsors that we deal with are all well capitalized so that they can weather an economic downturn. Who are the potential candidates for a DST? Really anyone with real estate assets who no longer wish to be personally responsible for property management. Very often these are older clients who may be less physically capable of property management. Also investors who are seeking greater asset and income stability by exchanging into larger, more creditworthy properties. Investors in high growth markets, particularly California investors, are often seeking greater income. In California, compared to the typical asset value of a property, the net income is often 1% or even less. So very often these investors are able to sell their property, exchange into a DST or a portfolio of DSTs, and increase their net income from 1% to say 4, 5, or even 6%. And very often this can mean the difference between continuing to work for a living or finally having enough passive income to retire. And then finally, we often work with investors who have already sold their property and are now at the end of their 45-day identification period. And they haven't found a local property that they're happy with and would like to consider a DST before their identification period expires and they're forced to pay taxes. What do we look for in a DST sponsor? Well, first and foremost, longevity. In every real estate upcycle, new sponsors pop up with very aggressive marketing campaigns and properties that look to have very attractive yields. And many times these sponsors, they really don't have the resources and their properties don't have the characteristics to sustain themselves in a vulnerable market. We like sponsors that have successfully navigated several market cycles and repeated property cycles, have consistently made money for their investors, and have really withstood the test of time. And that means we tend to focus on the larger sponsors. We like large, well-capitalized sponsors that have the resources to bid for the best properties, to obtain financing on the best terms, and to find tenants in a weak market, because frankly, that's why we're trusting our money to a third-party sponsor in the first place. We're looking for safety and stability. We also look for sponsors whose property offerings really have realistic terms and yields. The established sponsors understand the DST market and the typical investor, and they really offer the greatest odds of repeatable, sustainable yield and market values. New sponsors often offer properties with clearly above market yields that often make us suspicious because as we look under the hood, we find that often the tenants are not creditworthy, or they have short-term loans, or there's a short-term lease, or there's some aspect to the property offering that has an unacceptable risk for the typical DST sponsor. So we're really focused on realistic terms and yields, and we think reaching for yield in the DST market is a mistake. Let's look at some examples of DST offerings in the past from reputable sponsors. As we mentioned, a DST is accompanied by a prospectus, which has an almost encyclopedic amount of information for the investor to make their decision. So in our presentation, we're just going to look at a snapshot of a couple of key pages so that you can have a sense of the information that's provided, and by no means is it complete. The property we're looking at here is a Class A apartment building in the Tampa, Florida market. Here is a description of the business plan. It's a short summary of why the sponsor liked this property, why they bought it, what they're going to do to maximize value, how they're going to market the units, how they're going to increase occupancy and maximize rental income. Also, there's a short description on demographics. We look at the unit mix and the floor plans, including pictures, and all the amenities of these particular apartments. Here is a discussion of both the Tampa, Florida greater metropolitan area, the market, and also the submarkets. The population growth, the population trends, the income growth, the income trends, the competition within a certain radius of the properties, the income distribution within a certain radius of the properties, the largest employers in the area, everything that the investor might want to know about this particular market in which the property is located. In almost every prospectus for almost every DST from every sponsor, there is a description of the risks, which is a benefit of the SEC regulation. And this is present to give the investor really a balanced viewpoint of the property to make sure that they understand all aspects of the investment, positive or negative. This is another example of a DST property. This is a self-storage portfolio. It's 3 different properties in 3 different southeastern states. It's a short summary of the property and of the investment highlights of this particular DST. This is a discussion of the self-storage sector in the United States overall. And then here is a description of providing more detail on these particular properties. Here is a discussion of the location of the properties within the southeastern United States and the local market characteristics. Also, here is a short discussion of the local property manager that will be handling the details of these particular 3 properties within the DST. And finally, a third example. This is a DST with 15 different properties that contain very large credit quality tenants such as Walmart, Walgreens, dollar stores. As you can see on the right, there's a snapshot of the investment characteristics, the size of the investment, the size of the loan, the number of properties, and a little pie chart that shows the mix of properties within this particular DST. Here is a short description of the tenant information and also the lease and the location information of each of the tenants in each of the properties. Here is a description of this particular DST sponsor. It shows their size, their assets under management, the properties they have purchased, the full cycle property, cycles and offerings that they've had to give the investor some sense of what the property manager's like, if they've been successful, if they have the size and stability that we tend to require from the sponsors that we focus on. Of course, in every presentation of this nature, we must include the standard disclaimer that the information you have been shown is solely for information purposes and has not been an offer to buy or sell. If it had been so, you would have been given a private placement memorandum or a prospectus for you to be able to make an informed decision. So that concludes our discussion about fractional ownership in DSTs for a 1031 exchange. I hope you found it informative. If there are any questions, or if you'd like more information, or you'd like to see some current sample DST properties to consider, please contact your commercial real estate broker. Praxis Capital works with commercial real estate brokers because they understand your commercial real estate needs, and we feel that as a team we are able to offer a more complete advisory package to DST investors. So thank you for watching this presentation, and good luck.